Great. Good morning, everyone, or good afternoon if you're on the East Coast. It's just 10:30 now, but as always, we'll give it 60 seconds for participants to log in. We've got well over 50 participants in the webinar. There's a lot of interest in this topic, not surprisingly, given where the markets are. And so let's just give people a minute and we'll get kicked off very, very shortly. Good, I see people trickling in. Okay. Good. All right. Well, as always, we like to be efficient with your time, so let's just get going. The topic of the webinar today is how to deal with the bear market and rampant inflation. We want to cover, let's see if I can get my slideshow to work here. Two high-level topics. First, just a review of what's going on in the market today, and my colleague and partner, Charles Blankley, will speak to that. And then a discussion of financial planning around what's going on in the market today. I'm going to turn it over to Charles in a second here, but first, just some intros. I know we have a lot of clients on the call, but for those who don't yet know Charles and Brian, Charles is a Chief Investment Officer of Gemmer Asset Management, which is my umbrella organization. Brian Gemmer is the portfolio manager. All of my clients I know Brian quite well. And obviously, I'm Tim Corriero. I'm an attorney and a certified financial planner and the founder of Juris Wealth. And so with that, Charles, let me turn it over to you to discuss your section on what's going on in the markets today.
Great, thanks, Tim, and hello, everybody. Good morning, good afternoon. It's that time again when the markets are going through a bout of volatility, and so it's a good just kind of step back. What's going on? And where do we think things are headed over the next 6, 9, 12 months? And it's always, nobody has a crystal ball, but in this presentation, I thought we'd look back at a little bit of market history to maybe give us a hint as to where things are going. So what I'm showing you here are numbers from through last week. And so we officially hit bear market territory for the S&P last week, which is sort of unofficially defined as a loss of 20% from the high. So year to date, all the indexes are down double digits. See, the S&P is down 20. Russell 2000 is a small cap equity index, down 22. And bond yields have gone up a lot, right? So inflation has been increasing the last few months. The Fed has been hiking interest rates. They hiked 0.75 of a point last week. And both short-term and long-term treasury yields are up pretty significantly this year. And so we're in a bear market, but not all bear markets are the same. And so what I thought I'd do is look at historical bear markets that might give us a hint as to what the future might hold. And so when you go back through market history, we'd argue there's three types of bear markets. There's a cyclical bear market, a structural bear market, and an event-driven bear market. And so the definition of a cyclical is what we think we're probably in now. So it's one where the economy has been doing well, is doing well, and the Fed is having to raise interest rates to tackle inflation. So, this was the typical bear market we saw back in the 50s, early 60s. If you think back into the 90s when inflation picked up for a short period, that's what we've normally dealt with throughout market history, is where the Fed triggers a recession to get inflation down. That's the key piece. We usually have a recession associated with the cyclical bear markets, and profits usually go down. So you have a profit recession as well. And so if you look back in history, there's 5 examples, so in 46 through 48, the market declined 25%. The bear market took 21 months. It took 27 months to get back to even. And we don't have the profit data back then, but on the other examples, you can see what happened to S&P profits. So on average, these bear markets last 16 months, you get high to low declines of 25%, which is fairly close to what we have now. And then the markets are back to even in a little more than a year. But if, in our more recent history, we've all gone through two structural bear markets. And so this is the tech bust in late 90s, early 2000s, and then the housing crisis. And so, these are much deeper, more painful bear markets that last much longer. They're usually triggered by a structural imbalance or a financial bubble. You get a deep recession and you're worried about deflation, both during the bear as well as coming out of it. And so, the 07 to 09 period was the most recent, right? S&P was down 57%. It took you a long time to get back to even, and profits basically went to zero, right? S&P profits evaporated. And it was the same in March of 2002, right? A lot of us lived through the tech bust, 50% high to low decline. It took a long time to get back to even, and profits were cut in half. And then the other bear market that is more unique is an event-driven bear market. So usually this is a shock to the system. So you think 1987, right? You had a bear market in a single day. You usually don't get a recession. Profits are stable. And so you go back to the 70s, there was the oil price shock. Maybe there's an emerging market shock. COVID could very well be an event-driven bear market, although we did get a recession, but it was sort of a manufactured recession as we shut the economy down. And so there's been a number of those, but the key point is in red, that event-driven bear markets tend to be short. The decline still over 20%, but you get back to even fairly quickly. And that was definitely the case, right, with the COVID bear market. So the $64 trillion question is, what are we dealing with now, right? Is this a cyclical bear, structural bear, or an event-driven? And, I'd argue it's a cyclical bear market, right? That the Fed is hiking rates. They're trying to slow the economy because they are belatedly worried about inflation. And they're definitely playing catch up on the inflation story because they were talking about it being transitory for quite some time last year. And so they raised rates 75 basis points, so 0.75% last week. And that was only the third time in the last 40 years they've hiked rates by 0.75 of a point. So it's really a testament to, the Fed is serious, finally, about controlling inflation. They're searching for credibility. They want to tell the markets that they're going to get inflation down, whether it takes a recession or not. I think, where you go back to the history of cyclical bear markets, just give me a minute, and, they tend to be 25% sort of declines, 20 to 30% declines. So we're in the middle of that. So, I'm not arguing that the bear market is over, that we don't have more downside, but the market has priced in a lot of bad news. The market's starting to price in a very aggressive Fed and is even starting to price in a recession scenario. So if it does prove to be a cyclical bear market, it's quite possible in the next 3 to 6 months, the markets start looking through the possible recession towards the eventual rebound and towards the Fed easing policy again. I think what we need to see to make this a structural bear market, at least what we've needed historically, have been one of the points on this slide. So for this to become a down 50, a down 60 type of bear market, we need something to fail. We need a banking crisis. Households have to be carrying a lot of debt and they go into a prolonged deleveraging cycle, which is not the case at the moment. Households are actually in pretty solid shape. You typically have a currency crisis. Turkey is the latest example where the currency goes down 50%. That isn't on the cards for the United States at this point. Structural bear markets are tied to balance of payments crisis, where the country can't attract enough outside capital. Again, not a case with us. Where you get the Greek situation, where you have a sovereign debt crisis. And finally, you get a little bit of all of the above, which was Argentina a couple of years ago, where they defaulted. So, I'm not arguing that there isn't more bad news to come, but I think the odds of sort of a systemic financial crisis at this point are relatively low.
Charles, I guess just as a touch on too, you probably, obviously the markets were pretty surprised by how stubborn inflation has been in June specifically. including ourselves. How has your outlook in terms of what our view in terms of a bear market or a recession, how has that changed over the last 30 days? And what are you looking for to sort of change your opinion going forward?
Yeah, trying to predict a recession is tricky, right? Very few people have a good track record of doing it. So what we end up talking about is in probabilities. What are the odds of a recession in the next 6 to 9 months? Goldman was out over the weekend thinking, there's a 1 in 3 chance of a recession over the next year. Yeah, JP Morgan is sort of in that same camp of a 30 to 40% chance of a recession. If I had to guess, and I would qualify it that, at the end of the day, much of this is an educated guess. I'd probably be higher than that. I think there's a better than 50-50 chance we get 2 quarters of negative growth, which is usually tied to the definition of a recession. And I think that's what the market was worrying about in part last week, that we're going to start to see profits decline. I don't think it's a done deal because a lot of it will depend on how quickly does the Fed continue to raise rates. But I think the Fed will continue to hike. They won't stop until they see inflation roll over meaningfully. And so that could set the stage for what would probably be a short and shallow recession, but a recession nonetheless. I think the good news is you're seeing hints that we could see the peak of inflation over the next 2 to 3 months. So for one, energy prices have come off the boil. So this is a chart of gasoline futures. They basically have gone parabolic since the war in Ukraine started. And they were down 6-7% last week. Crude oil sold off. And if you look at commodities for June, really there's only 2 that are up. The rest of them, so the other 15 to 20 are down anywhere from 5 to 10%. So commodity inflation was a big contributor to the inflation numbers in March and April. It's quite likely that commodities will take some of the sting out of the inflation data over the next month or 2. And then we're seeing the supply disruption situation get better. So one of our research firms we follow puts together a supply disruptions index of all things. That's the blue line on this chart. So you can see it got very bad in late 2020, early 2021, when people were spending their stimulus checks on Pelotons and so forth, right? Amazon orders were through the roof. Well, it's fallen down significantly. It's come down significantly, and so there's a case to be made that as the supply chain heals, we could see inflation soften. And so I don't think it softens enough to stop the Fed from hiking in both July and September. But I think as we get nearer the end, the Fed could very well start sending signals that we're going to take a pause and see how things pan out. And that's probably the key for the markets, right? Once they get a hint that inflation has peaked and the Fed may change their tune, you could see the markets bottom. And at least historically, and again, if we look at historical parallels for hints for the future, that tends to be the way the markets work. And so this shows you the S&P in 73, 74, the last period of stagflation that we went through. And the lighter line is GDP growth. So you can see that really the recession started in late 73, early 74 as growth declined all the way through the middle of 75. And then it bottomed, in March, April of 75, and growth started to pick up. But the equity market, after going through a pretty painful bear market there through the end of 74, bottomed way before the economy bottomed. And that's what we see during most of these cycles, is that stocks turn higher before the news gets better, right? That it's a discounting mechanism for the future. And so if I had to guess, when the market gets a hint that inflation's peaked and the Fed may step aside, we could see a decent rally. We could see the market bottom and rally from that point, even though the news isn't going to get better for a few more months.
Got it. Charles, if I could just chime in on that slide, the last significant market decline that we experienced with our clients is obviously COVID, right? And we saw a very similar dynamic. I had clients that were very, very nervous, including some who decided to lower their equity allocation or make some material trades against our recommendation, right? And what we saw was that the equity markets recovered very, very quickly, far more quickly than anyone anticipated, right? And so news is generally priced in far in advance. We don't know if the equities market's going to fall any further than it is, but I would suspect that it accurately reflects that 30 to 50% likelihood of a recession, right? With professional investors have traded stocks to that point, and it's one of the problems with market timing, which is probably a great dovetail into my section. And so let me take over from here and discuss the financial planning element and sort of overlay, Charles, of all the information that you shared, right? And so with that, let me see if I can get this to work here. Topics to briefly address, and I'll be very, very efficient again with time here. First, behavioral elements of investing. Second, market timing, some comments on why it doesn't work, because it doesn't. Third, what to do about inflation. Brief comments on value investing, and then finally some specific recommendations. So to start with, on the behavioral element, do stocks create wealth? The answer is no, right? This is a little bit teaser. Why is that? Stocks don't create wealth. Your behavior around stocks creates wealth, okay? It's a truism in the investment management and financial planning industry that there exists what we call a behavior gap between what investment returns are and what investor returns are. To explain this and to put some specific numbers on it, there's a company called Delbar that for quite a long time, every year they come out with a study called the Quantitative Analysis of Investor Behavior, right? It's called the Delbar report. And every year they come out with numbers that compare returns on underlying indices and the returns to equity investors in those indices. Here we can see this is the latest that came out at December of last year. The S&P 500 on a trailing 30-year basis generated a 10.65% annual compound return. Would have turned into slightly more than $2 million. The average investor, however, generating less of a compound return, generated $800,000, so materially less. Now, there are reasons to quibble with the analysis that Delbar utilizes, and I have good reason to believe that the behavior gap, right, the lower returns that investors generate isn't this bad, but directionally it's absolutely accurate. All right, so let me zoom out and give you a more macro picture here and show you a history of bull and bear markets to put the current bear market in context. This is a chart that shows the U.S. stock markets going back to the S&P 500 going back to 1926 to current. And it shows the bull markets on top and the bear markets on the bottom. And there's a couple of things to notice here. The bull markets are of significantly longer duration on average and of significantly higher returns relative to the losses generated in bear markets, right? That's to understand bear markets in the broader context. So we are here, right? The financial planning issue is the following, that the price of investing in equities is you've got to deal with this, right? The bear markets in order to earn this. There's no other way, which begs a little bit of a question. And this is a sketch I like. It's from the behavior gap. You can focus on the short-term ups and downs and volatility of the equity markets. And when I say short-term, that includes the time frame of a bear market, or the long-term creation of wealth through consistent investing and being disciplined through cycles, right? Now let's talk a little bit about market timing. As I mentioned, I had a number of clients during the COVID crash that called me and said, I can't handle this. I need to get out, or I need to change my equity allocation. That was the wrong decision. Market cycles generally follow this curve, right? This is a greed fear cycle, and we are solidly in the fear element of this cycle, right? As proof of that, CNN has something they call the Fear and Greed Index. I screen capped this, I think this was just yesterday. We're solidly in the extreme fear range. This is when people make bad decisions and suboptimize their returns. So why not sell now and get back in later? I get this question all the time, and it's a legitimate question, right? I'm going to give you two very good reasons. The first is behavioral, and that is humans are terrible market timers. And that is because we're subject to a whole range of cognitive biases, which preclude us appropriate, analytically driven choices about when to invest and how to stay invested, right? And I've just listed some here. We could go into any number of these, and there are far more than these, but each of them would cause us to make the wrong investment decision when you look at things completely analytically, completely from a risk neutral perspective. All right, so that's the first reason. We're just terrible market timers because we're subject to these cognitive biases. The second is purely analytical, and I'm going to refer you to a blogger that I really like. It's called, his name is Nick Majuli. He recently wrote a book. His blog is called Of Dollars and Data. And he had a blog post recently that was titled, Even God Couldn't Beat Dollar Cost Averaging. And one reason I like this author is that he takes financial planning principles like the ones that I've been sharing with you and interprets them through the lens of actual analytics of historical market performance. Okay, so he took an example and looked at the S&P 500 and he said, what would happen if we look back and said we had perfect knowledge of when the market would bottom and only bought then, right? So that's buying the dip. And then let's compare how we would have done had we simply dollar cost average our investment over a period of time. A little bit surprisingly, buying the dip, right, buying only at market bottoms with perfect information underperforms dollar cost averaging on analytics. And there's a reference here to the website, so you can look at this yourself later, but that's the takeaway. He also did an analysis that said, suppose we don't have perfect market knowledge, because no one has perfect market knowledge, but we're pretty good at it. If we're pretty good at identifying a market bottom and buying within a 2-month window of a market bottom, compare that approach to dollar cost averaging. That buy the dip approach underperforms 97% of the time, right? So put all that together, market timing doesn't work, and we ought not try. All right, now, what do we do about inflation? Obviously, this is a big concern for everyone. All right, number one, first, if it's consistent with your risk tolerance, you should maintain at least, and if not, increase your equity allocation. Now, why is that? Because bonds are nominal assets, right? They're not inflation indexed. Equities aren't inflation indexed either, but as a practical matter, they are. Bonds, you give a company $1,000 today, you get your $1,000 back 10 years from now. It doesn't matter if the purchasing power of that $1,000 is much less. They're nominal assets, right? What we care about is the real value of your future dollars. So again, if your risk tolerance permits, you have to at least maintain your equity allocation and maybe increase it. Next, tips. A lot of people talk about tips. We look at them ourselves, and they provide protection, but at a cost. Okay, specifically, what do I mean by that? Let me actually back up. What tips are? Tips are treasury inflation protected securities. Larry Summers, when he was the Secretary of the Treasury, came out with this and said we ought to offer a product to the market, which are treasury bonds, U.S. government debt, but where the principal adjusts dollar for dollar with changes in the CPI. So if you buy a TIPS today directly from the U.S. Treasury, if you hold it until maturity, the value of that TIP will accurately reflect all compound CPI over that intervening period. It is a perfect inflation hedge if held to maturity. Okay. subject to some caveats. Number one, as a practical matter, if you went out in the market and bought a TIPS, your yield would be negative, which means you're paying such a premium for that inflation protection that in comparison to nominal bonds or an absolute basis, your yield will actually be negative. That's actually not true now. Yields have gone up, but until recently they were negative. Secondly, while if you hold until maturity, your principal will accurately reflect changes in the CPI over the holding period. On a mark-to-market basis, that is not true. Bonds fluctuate in value if you go out into the market to sell it, and you are not guaranteed that the market will value it at any particular point. So TIPS make sense if you are a hold to maturity. I should also say that the increase in value in the TIPS, right, the imputed return that you get on that principal adjusting for CPI is taxed at ordinary income rates. And so there's obviously leakage there. They're much better held in tax deferred accounts. And then finally, you can actually generate a better return with nominal bonds if inflation ends up being lower than expected, because TIPS are priced. If inflation is either higher or lower than that, you're going to do better or worse on your investment. So in summary, TIPS are a great investment, but with subject to a number of caveats. Next, I bonds. I love I bonds. The problem is you can only buy $10,000 of them. At the moment, the yield is quite high. It's 9.62% through October. The yield is directly tied to a measure of inflation, but it's small dollars and the hassle factor is large. A few of my clients do it. The website at Treasury Direct is such a pain. A lot of people just decide to pass. You're capped at $10,000, right? Next, traditional inflation hedges, gold and crypto. Obviously, you all know what's going on with crypto. It is clearly not, at least in the short term, performed as an inflation hedge. Gold has retained its value this year. It has not been a positive performing asset, but over the longer term, the inflation merits of gold have not been that strong. We do not have an allocation to gold. Finally, I would say understand your personal inflation risk. It's easy to look at the headline, but your lives are not directly correlated. The expenses in your life not directly correlated with CPI. For example, half of the run-up of the CPI last year was the cost of used cars. If you're not in the market for a used car, it doesn't matter. Your personal inflation risk is going to be something different than the CPI, right? So let me give you a couple tangible examples. A fixed rate mortgage. If you have a fixed rate mortgage, that is an enormous inflation hedge, right? If you have a say a 3% mortgage, don't pay it down. Next, do you have a 529 plan that is funded or being funded? You are insulating yourself from inflation risk. Are you going to eventually be Social Security eligible? Will you have a pension? You further insulating yourself from inflation risk. Again, your personal inflation risk is risk. Now, a comment about value investing. I know this is a little bit of a non sequitur, but I think this is really exciting and it's something that people can do currently. Over the last several years, growth assets, growth stocks, tech stocks have significantly outperformed value stocks. That is, at least until the end of last year. Okay, values currently valued at an enormous differential relative to growth stocks. This chart attempts to show that, all right? And it's a little bit technical. The point is, the higher the point is on the chart, the more significantly undervalued starting to decline, right? So value stocks are still much cheaper than growth, but a little bit less so because value stocks have done well.
Tim, you just cut out a little bit there when you cut out after talking about the despite the peak of that chart, that value stocks are still significantly cheaper than growth. You might want to hit that again.
Perfect, good. And you summarize it. And if this drops again, Brian, you can just pick up. To make this really tangible, let's look at the Vanguard Value Index. Year to date, it's down 13%, right? Compared to the Vanguard Growth Index, which is down nearly a third. It's a drastic differential. Value stocks still look significantly undervalued compared to growth, and it's an area that we're particularly interested in, and that's the way we invest our money. Now, tangibly, what to do? Let me end this with just a few specific points. Number one, stick to your plan. You should have a plan, and it should have contemplated a bear market such that we find ourselves in. Stick with it. Number two, if you're buying, if that's part of your plan, keep buying. Okay. Deciding to hold off or wait is market timing, which again has been proven not to work. Third, value stocks. The parenthetical here is DFA. DFA is a mutual fund company, Dimensional Fund Advisors, whose funds are generally considered to be value funds. It's a little more complicated than that, but we do have a DFA portfolio that we invest on behalf of our clients, and I urge you to look at it if you haven't. Fourth, tax loss harvesting. Brian and I have been doing a lot of work recently harvesting tax losses. This can add a material component of your total return. We were just talking prior to the webinar here that studies suggest it's anywhere between 50 basis points and 250 basis points, right? That's 0.5% to 2.5% by proactively tax loss harvesting. I won't go into the specifics of what that means. That's a topic for another webinar, but it's key to our strategy. Bond portfolio, keep a shorter duration and higher credit quality. That's what we're doing in our portfolio. Shorter duration means we're not having long dated bonds. The longer dated your bonds are, the more prone the price of that bond is likely to fluctuate as interest rates move. Higher credit quality, far more important if we head into a recession. Finally, mortgage. If you have a mortgage with a cost of, so a fixed rate mortgage with a cost of 3% or so, do not pay it down. That is probably one of the most powerful inflation hedges that you have on your own personal balance sheet. And then finally, cash. They're much better places to hold cash now compared to 6 months or a year ago. High yield savings are paying a little more than 1% at the moment. That'll go up as the Fed continues to tighten. But a non-traditional approach, which we've been employing for some clients here, is to simply buy a treasury bond. Right, whether you buy a T-bill, which is shorter than a year in duration, or a bond, which is longer than a year in duration, yields are pretty attractive. So the 1-year U.S. Treasury is yielding close to 3%. Buy it now, hold a maturity. That's a perfect return. That concludes our discussion today. Let me look and see if we have any or questions. Good. I have a question here. Charles, where are PE ratios now, and how do you think about them relative to whether assets are in the equity markets today?
So if you look at the S&P 500, and if you're looking at forward price earnings ratio, so what's the value based on estimated earnings, we're right around 15 times. And so if you go back the last 30 years, it's a little more expensive than average. The average is probably 14.5, somewhere in that range. So the question is, what's going to happen with earnings is the big question. So if earnings don't decline from a value perspective, we're probably fairly valued. If we're going to see an earnings recession in the next 6 to 9 months, then the market is more expensive than it appears at the moment. So that's the potential next shoe to drop, is that we see earnings fall. I guess my take on it is earnings declines are probably going to be sector specific. And so, Tim talked about the value growth trade. So, if you look at a lot of the aggressive growth stocks, sort of the Pelotons of the world, Netflix, Nvidias, and so forth, we're likely to see earnings declines in that sector just because the profits are shrinking, revenues are shrinking, so their capital expenditures are going to fall, and that whole ecosystem is going to shrink. I think if you look at some of the value sectors, so energy stocks, material stocks, commodity-based stocks, even banks, we could see earnings proving to be pretty resilient. So I think it ties into Tim's point, in building a portfolio, I don't think it's trying to time earnings go down, I'm going to get out and get back in when earnings peak up. I think it's tilting the portfolio in favor of those sectors that should see pretty resilient earnings over the next 6 to 12 months.
Good, thank you. I have a basic question here. This is worth answering. Charles or Brian, either you can take this. It's a great question because we presume this in our presentation. Why are bonds not good investments in a high inflationary environment?
Want to take a step, Brian?
You go take it first and I'll add to it.
Yeah, so the trick with bonds, so if you think how a bond works, you buy a bond for $10,000 and you're guaranteed, if you're buying a treasury bond, a certain interest rate. So say you're going to get a 5% interest rate, and that interest rate is fixed regardless of the inflation environment. So if inflation is 0, you'll get 5. If inflation is 5%, you'll get 5. So on a real basis, you won't make any money adjusted for inflation. If inflation is 10, you'll still make 5. And so the value of your investment, once you adjust for inflation in that high inflation environment, has gone down. Basically, you're losing purchasing power every year. So that's the challenge with bonds, is when you buy them today, you're making a bet on what future inflation is. And so bonds have struggled the last 12 months because inflation has come in much higher than people thought 12 months ago. Is that?
I guess the one thing you'd add, right, is the nice thing about bonds is they have a maturity. So as they do mature, you have the opportunity at reinvesting those proceeds into higher yielding instruments. And that's a unique function of bonds, whereas, relative to equities. And so, it is an interesting space. While we have had a fair bit of pain this year, right, with how much interest rates have risen, therefore being decline in bond prices, finally, we're getting decent yields now in bond areas in the fixed income market. So in some respects, as Tim just alluded to, right, whether it's a 1-year treasury or high quality credit, there's actually now some decent yield in the bond space that we haven't had for many years, quite frankly.
That's a good point. And you also own bonds, if worse comes to worse and we get that structural financial crisis, that we had in 2000 and 2008, we don't think we do. But as a hedge against that worst case scenario, typically bonds make money in that environment because interest rates come down. So from a portfolio construction standpoint, having some bonds does make some sense as a hedge. There's other ways to hedge your portfolio, but that's one of the ways to hedge.
Great. Good. I have another question here, which, Brian, I'll just put to you. I mentioned tax loss harvesting, another great basic question. Can you briefly explain tax loss harvesting and why we do it?
Yeah, essentially it's the idea of having, the simple analogy we always use is, let's say you own Coke and Coke's down 10% and you want to realize the loss of owning Coke, but don't want to be out of the market. Okay, well, you sell Coke at the loss and then you go ahead and buy Pepsi. So now you've realized the loss of Coke, but now you own a similar security in a similar sector, a similar market cap, and something the same. So your exposure in the markets and your portfolio allocation is not changed, but you've allowed yourself to realize a loss, which you can do one of two things. If it's a short-term loss, you have the ability to offset $3,000 of ordinary income. And additionally, to the extent you have other gains in securities you've made, whether it's a home sale or whether it's other equities that you sold at higher peaks or at higher, realized gains, you can offset those gains with this loss. And if you even have more losses than you do in gains in a particular year, you get to carry them forward to future years. So where we found this particularly interesting is in core asset classes where there are very easy surrogates into different ETFs or exchange traded funds, whether it's Schwab growth and go into Vanguard growth, which is essentially the same security, but you get the loss and you're still similarly exposed. And it's allowed a lot of folks who had legacy positions that were carrying gains where they could now more optimally position their portfolio without a significant tax consequence. Because what we've had, right, particularly in the run up over the last, since 2020, particularly in tech stocks, a lot of embedded gains in a lot of concentrated names. And there was nothing to shield any of those gains to help sort of more optimally put your portfolio in a risk adjusted basis. So that's kind of the making lemonade out of lemons, if you will.
Good. And obviously, Brian, you and I have been doing a lot of tax loss harvesting, and it's done on an individual basis and consistent with the financial plan and what the clients want. Good. I don't see any other questions. So with that, we'll end the webinar. Thank you all for participating, and I'm sure we'll do another one in another few months, and call us with any questions. Thanks for your time.
Thanks, everybody.
Thank you.